Good evening, everybody. My name is Vinod Kenny. I'm the Executive Director of MyCFO, and thank you for joining the webinar today. We're going to be talking about getting ready to raise your Series A, which is the first institutional round of venture capital for a business, and all the things that the company should be doing and be prepared to do as part of the whole process. In order to sort of be able to make it much more efficient and also have bandwidth not be unnecessarily hogged, I'm actually going to turn off the video link and continue this on audio. And any questions that you have, please wait till the end of the session, and then we're going to have a Q&A session, at which point I'll be happy to answer any questions that you may have. So what we're going to discuss today is the introduction to raising equity capital for your business, the difference between the various stages of capital raising, which is very frequently used, which is seed, pre-series A, Series B, so on. The other one is to talk about getting your organization ready to go and raise Series A. And when I go further into this, the difference, as I said, between seed and Series A. And Series A is a little bit more of professional investors, which is venture capital firms, which also means that your organization or your enterprise has to be a lot more, what shall we say, has to be a lot more prepared for this whole process. And that's the reason why we want to essentially go into that. Organizational readiness from a finance and operations perspective. Then we'll also talk about strategies for getting funded. What are the hygiene factors or prerequisites that are necessary before you pitch to a VC? Then we'll also talk about the use of consultants and advisors as well as investment bankers. And then finally, we'll wrap it up with our own MyCFO's experience and expertise in this whole process. So a bit of an introduction. I'm currently the Executive Director of MyCFO. In addition to that, I'm also a partner and an advisor to an early stage fund called Artha. And I'm also a founder director of Peachtree Management Services, which is a cross-border management consulting company. I have been an angel investor for several years, still continue to be an active angel investor. But I've also been a serial entrepreneur. I've started and sold companies both here in India as well as in the US. And earlier to that, I have been the CFO for an impact fund called Avishkar, which is India's largest impact fund. And I've also been an advisor to several private equity and VC funds, in addition to having started companies. So more about me is on LinkedIn as well as on MyCFO's website, where you can get more information about me. So let's get started and let's talk about raising capital. The first question that invariably comes is, do I really need capital? And of course, I'm talking about companies that are probably not so early because we are primarily focused on Series A. So which means that these are companies that have sort of grown a little, have actually got customers, have revenues, business model is fairly well defined, are now starting to primarily look at significant expansion and growth. So I'm primarily focusing most of this conversation and this webinar around companies in that stage. So I'm not necessarily going to be talking too much about early stage companies, which are these companies that sort of typically go out and raise seed rounds from angels, angel networks, or from smaller seed round funds. These are primarily, we are primarily going to focus on venture capital, which is Series A and beyond. So a few things that I want you to keep in mind is the fact that though there is a lot of news in the media about fundraising stories and fundraising successes, including one I'm sure you saw today about Ola raising 1.1 billion. The number of companies that actually raise outside capital, which is venture and private equity, are fairly small compared to the overall number of companies that are out there. And that's because fairly a large number of them are still traditionally bootstrapped and expand, or they have essentially decided to do it in a different manner, or they don't really need venture capital. So to say the least is that, typically if you look at the entire landscape, probably less than 3% of companies actually get venture capital or some kind of outside funding for them. Though it also sounds very fashionable, and you sort of think that it's a very hip thing to talk about being venture backed, it is extremely challenging, tiring, and time consuming, and it's not a very easy task. And in this whole exercise, one of the things that we typically see is the fact that founders and promoters have to spend a fair amount of time, which also means if you don't have a good team that's actually running the business, you could lose focus, and your business may also suffer. And there are enough instances of companies that have sort of had this problem and this challenge as well. And the other thing is the fact that not every fundraising exercise is successful. Not everybody who goes out into the market to raise money end up raising money. A lot of them don't. And then the other thing that, of course, which is more relevant to early stage companies is that you may raise one round of capital, but you may not necessarily be able to raise subsequent rounds. And right now, research as well as trends clearly point to the fact that there are a lot of companies that raise seed and early stage capital, but have not been able to raise Series A and beyond. Or there are companies that have raised Series A rounds, but have not necessarily been successful in raising Series B, C, or D rounds. So sort of keep that in mind as well. The other thing, like I mentioned about, is the entire emotional and mental toll that it takes, because this entire exercise can be, like I said, extremely long and challenging, and there is a lot of going back and forth with investors and all kinds of questions and all kinds of issues that come up. It also does come up with a cost, and there is definitely all challenges there. And then, of course, there are other things that you also have to think through as to, what are the various stages of growth of the company. When do I need really capital? Do I really have enough capital? Do I really raise all the money at one go, or do I raise them in stages? At what stage do I really need money? And this also means that there's a fair amount of thinking and visualization that promoters and management teams have to do prior to actually going out and raising the capital, because these are questions that investors invariably ask, and they want to make sure that promoters have actually thought through. If you actually listen to some of the more successful entrepreneurs who've gone out and raised venture or private equity, you will realize that they have a very clear, crystal vision of where they see the business going, how the business is essentially going to expand and grow, and the kind of resources that they need at various stages. And that's the exercise that entrepreneurs, promoters, and their management teams need to do. The other thing is the fact that, and this is a very basic question or a basic issue to think about, and that is that not all businesses are fundable. I'll talk a little bit later on about venture capital and the kind of returns venture capital looks for. And though businesses may be doing well, they may be sustainable, and they may essentially have profits and maybe doing reasonably well in terms of growth, they may not necessarily be on the growth pattern or the growth curve that gives the kind of returns that venture capital funds are looking for, which also means that some of these businesses are not fundable. So, which also sort of is the issue that most promoters also need to understand, is that just because an investor says that he doesn't want to fund it, or that he says it's not fundable, does not necessarily mean that the business is bad. It just means that from their perspective, it doesn't really make sense to actually invest into a business like this. And then, of course, the last one is the fact that when you're looking at outside resources or outside equity capital, venture capital is not the only option. There is a whole bunch of other options, including debt, that's also available to you. So this is I think a question that sometimes people ask. So in the interest of sort of wanting to make sure that everybody is on the same page, I thought I'll have a short couple of minutes on what venture capital is. So venture capital is essentially equity capital for new and growing businesses. It's typically used by businesses that are sort of growing extremely rapidly and are looking at leveraging market opportunities, and outside capital makes a big difference for them in scaling their businesses up. It is unsecured risk financing, which means it's 100% risk capital. If it's invested and the businesses don't do well, that money is lost, and that money it cannot be returned. Typically, venture capital funds, they raise pools of capital, and they typically raise them from institutional investors or individual investors. Individual investors tend to be ultra high net worth individuals, family offices. Institutions typically tend to be people like the SIDBIs and the LICs in India, SBI, for example, and then also a bunch of corporate family offices or corporate funds as well. They're typically used, like I said, to finance new and rapid growth. Most venture funds will take common equity or preferred equity. They will all want board positions, so they'll all be actively involved at the board level. And most of them tend to add value through active participation and support. So it's not just capital that they're bringing to the table. They're actually helping with networks, access to capital, access to markets, recruitment, partnerships, all of those. And like I said, venture capital typically is taking on higher risk because it's risk capital. So they're also looking at higher returns. So they're not necessarily looking at returns like what banks would be looking at, right, which is in the teens or so. Most venture funds have IRRs that have been promised to their own investors, which are anywhere upwards of 35 to 40%. And those are the kind of returns that venture funds are looking at. And most venture funds tend to be of limited life. So typically venture funds are set up as 7-year to 10-year lives. Of course, some of them are even shorter at 5 years. And which means that by the end of the 7th year or the 8th year, they will have to pretty much complete everything, including investing, harvesting, getting the money out, and returning the money if there is money and profits back to the investors that have committed capital to them. How do they typically make money? They make money when the equity that they have in companies is sold through an M&A, through an IPO. Sometimes there are promoter buybacks, which were sort of popular in India a few years ago. And then, of course, now a very popular use is through secondary sales, where later stage or larger hedge funds and venture funds and private equity funds are coming in and buying out entire portfolios of earlier venture capital companies that are looking to exit. This is one thing that I also sort of wanted to talk about, and that was the difference between angel, seed, pre-series A and series A, because these are sort of terminology that you sort of see being tossed around fairly often. And from that perspective, I wanted to sort of highlight some of these things. And of course, enterprises at the very early stage of development raise equity capital at various levels and various sources. So I thought, we'll talk about what it is and what stages. So typically, let's start off with the very early stage, which is friends and family. And that is typically when you're launching a business and you're just getting it started and you need some money to build your prototype, or you want to get your product defined, and you necessarily need only a little bit of money. And this usually comes from friends and family and people who really sort of are supporting you primarily because they happen to be friends and family. In this situation, the equity dilution is very subjective. In most situations, it may end up being a loan, and the equity dilution is also fairly minimal. The subsequent round is an angel or a seed round, and this is where angels, angel networks, seed funds typically participate. And in this situation, the product has had some limited launch. There are some customers and there's some product validation that's coming in. There is some user product fit that is now starting to happen. And essentially, it's going to get used to build a team out, and it is essentially going to be used to actually expand and take the product into the market a lot more and try and expand the customer base. Here, of course, valuations are also very subjective, though people try and put all kinds of valuation metrics and methodologies together. Ultimately, this is a valuation in this entire process is extremely subjective, and it is also based on the amount of money that has been raised, what kind of traction the company already has, how much this money will last for, track record of the team that's actually out there building this company out, and whether they have been serious successful entrepreneurs earlier, and all of those. So like I said, typically this is coming from angels, HNIs, family offices, and seed funds. In some situations, between the angel round and the Series A round, there is what's called as a pre-Series A, and this is usually done as an interim round, because the company sometimes may have gotten to a situation where they still need a little bit more capital to be ready for Series A, which means that the market product fit is still not complete, and they still need to go out and do a few more things before they're really ready for Series A. And knowing the fact that Series A typically takes anywhere from a minimum of 6 months to a year, they essentially want to make sure that there is resources available for them as well. And so a lot of them end up doing a pre-Series A, which is more or less an interim round. A lot of times the pre-Series A is usually done as a convertible, which is with a discount to the Series A round valuation, depending on timelines within which those things get done. And then of course the focus for today's webinar, which is Series A, which is at the point where you're optimizing your product and user base. You already have a user base, you already have a product, and you're looking at a wider product range and scaling the business up. At this point at Series A, you have a clear plan for long-term growth and sustainability. You actually have a vision of how you want to build the company out and how you want to really grow the company out. This is also the time when institutional investors, when I say institutional investors, professional investors such as venture capital funds typically step in. There is a significant amount of equity dilution, anywhere north of high teens, and it's fairly common to see them going not only into the 20s but sometimes into low 30s as well. They typically ask for ESOP plans to be also put in place for the entire team, and that's fairly common. And then there is a bunch of corporate governance that also comes in, which includes composition of the board. Sometimes board essentially being made not only of promoters but also of investors as well as outsiders, in order to sort of help build the company up. So these are the sort of the various ones. Of course, then it goes into Series B, Series C, Series D, and that's where in Series B is typically called as a build, where they're essentially building on the successes achieved during Series A and expanding beyond that. And Series C and Series D is typically private equity, and that's where significant rounds of capital are raised with the idea of essentially expanding and trying to build market leadership. So here's a chart for where all the different stages are done and who's typically involved in this. If you actually sort of look, there's also mezzanine debt, there's late stage VCs, and there are quite a few of those in India that operate in the mezzanine and the late stage ones. And of course, you have private equity, public markets, pipes, as well as corporate bonds as well. So let's go to the next one, which is, are you ready to raise Series A? And you sort of now feel you're at a point where the company is doing well, you have customers, they're willing to pay for it, you actually now have more and more repeat customers, your business model is now starting to get validated, you now have revenues, you've sort of built a decent enough core team of people to execute, and you sort of now have a pretty good plan of how you want to really grow this business, and you now want to go ahead and do this again. So that's one thing that we essentially sort of will talk about, and that's how are you are you ready for prime time, which is Series A. So the one thing that is really important is the ability for you to be able to tell a very compelling story about the business and how the business is going to grow, and that has to be compelling enough and interesting enough for investors. And this is something where outside consultants, advisors, investment bankers really help. And the reason for some of this is the fact that a story around what you're trying to build, how you're going to build it, where it's going to take is what investors are looking for, because that essentially tells them the fact that you're thinking well into what the vision for the business is supposed to be. But at the same time, keep it simple. Don't have to make it too complicated with too much technology or too much detail thrown into it. You want to try and keep it simple and straightforward. If you want to be ready for this, the other thing is to make sure that there is a core team of people around you. That would be, people who will help you with product and product development, depending on what kind of product it is. People who are sort of in, if you're in the manufacturing space, people who are sort of being able to help you in the whole manufacturing, which includes quality control. It's also sort of being able to build people around sales and marketing, and sometimes even a CFO in place. It also is the time for you to actually have a good team of advisors, which is called as a kitchen cabinet, because these are typically people that you know well, people who have domain experience, domain expertise, have significant experience in operations or in industries, and can actually help with this building and the scaling up of the company. And then, of course, being able to now build a plan, a financial plan, and a pitch deck, you have to actually have those done as well. There's also the target list of investors that you also want to actually start putting in place, because of the fact that not all investors are interested in all companies that come in. Most investors actually have sectoral preferences. They also have sectoral focus. They also have limitations in the amount of money that they want to invest, what kind of companies, geographic location, all of those. So you have to be able to customize the list of investors that you really want to talk to and really want to target, because you can't essentially go out there and try and waste time and energy, going out and blasting everybody, all the investors that you sort of come across through a list, because not everybody is going to be investing into a particular entity because of sectoral preferences and others as well. The other important thing is to be able to practice your pitch, learning how to communicate, being able to actually talk. There was an excellent article a couple of days ago on what's called as a conversational pitch, where people are actually pitching ideas or pitching business plans as well as investments without necessarily using a pitch deck, which went back to the first comment that I made, being able to tell a compelling story. And then, of course, the other thing is, before all of this happens, for people to actually understand cap tables, how cap tables are, the dilution that happens at every step of the way, and all the way towards the end once you've raised money. This is really important, because promoters need to understand right at the beginning as to the equity dilution that happens at every step of the way. You may probably decide that, hey, listen, I need to go out and raise a significant amount of money. But for significant amounts of money that you have to raise, there's also equity dilution that happens. And at the end of the entire exercise, you also want to make sure that promoters have meaningful equity in the company, because without meaningful equity in the company, having put in all of this effort is not really going to be worthwhile. And I have personally seen several instances of companies where equity dilution is so significant that the promoters have very, very little left, and there's no motivation for them to make the enterprise successful. And you don't want to be in that situation as well, both the investor, because the investor ends up ultimately losing out, and the promoter as well, because the promoter has sort of put in blood, sweat, and tears for a fairly long period of time in order to make this thing work. And of course, the other thing is to be able to understand the key terms of the term sheet and the SHA. What are drag along rights? What are participation rights? What are minority rights? What are ESOPs? What are CPs and what are CS, and all the other things that are sort of part of the term sheet as well as the SHA. And I think it's good to understand and be able to sort of know what they really mean, because once you start talking to investors, these are some of the terms and terminologies that venture capital funds sort of use fairly often. So here's a short, this thing on investment readiness and being ready to raise. And these are 4 important things that venture capital funds look at when they look at a company and saying, are these guys ready for Series A? One is scalability, the ability to scale quickly and address a need in a growing market. Is there a team which is a mix of domain experience, execution capabilities, and passion? Is there operations already in place or coming together that can actually support scale and ability to build an organization? This is always a chicken or egg situation. Do I build operations and support and then wait for the customer to come, or do I essentially bring customers and revenue first and then build operations? And this is a dilemma that a lot of companies go through because operations essentially means burning through cash a lot more faster. And sometimes you build operations and you build the support infrastructure and you don't necessarily see a corresponding increase in revenue, or you see revenues coming in significantly and that grows fairly fast, but you don't have a supporting organization, which also means that the customer experience is not great enough when the customer starts leaving, in which case you also lose out. So that's a very, very important aspect that Series A round companies need to clearly understand and be ready with. And of course, the other is also to do with financial models. What are the business models? Is it sustainable? Do I really know when I'm going to be making money? Is my revenue model and my business model something that I can really articulate and talk about? Am I really convinced about it? Does it lead to long-term sustainability? And how do I really continue to keep this refined as I grow along? So one of the things that I wanted to bring about in all of this is the company's readiness to actually go ahead and be ready to go out and raise Series A rounds, right? Seed rounds are early stages, and in the seed round, you don't have much in the company. But at Series A, you already have customers, you already have a team, you already have revenues, you already have product market fit, as I was sort of talking about earlier, which essentially means that you as an organization have also got to be ready. The reason is a venture fund that's sort of coming in and providing Series A capital is also sort of assuming, and not only assuming, is sort of really looking to make sure that there is an organization and an enterprise that is being built, and that it has now gone beyond the promoters working out of a garage, or the promoters with a very makeshift operations and makeshift manufacturing or outsourced manufacturing. So all of these are critical issues that investors really look for. And from a financial and an operational perspective, some of these aspects that I've sort of listed here are also equally important, because I have been part of companies as a CFO where we have raised capital, and when we have been raising capital, we have also made sure that the organization from a financial and operational perspective are also ready. But I've also seen companies where financial and operational readiness was not there, and some of those have actually gone to the point where even after having gotten a term sheet and a commitment to invest by a venture fund, and I'm talking about Series A institutional investors and venture capital funds, those transactions have not been successful and have not been consummated. And a big reason for that is the fact that these companies were financial and operationally not ready. And this is a very critical element which can actually make or break an organization, especially when it comes to Series A. So let's go through what is it that we really need to make sure that it is all available and ready. One is an experienced CFO. Now that CFO may be part of the team, maybe an outsourced professional, maybe part-time, but somebody who can think and communicate strategically and lead that entire fundraising exercise. Somebody who's able to articulate business models. Somebody who's able to talk about the scalability of operations. Somebody who can essentially talk about revenue models and be able to articulate this along with the promoter. So this is really important, and this is something that I have seen as my own experience is something that's sort of crucial in the success of a Series A or a Series B rounds of capital. Then a finance team, an accounting or a finance team, which has good insights into the numbers and the business, is able to sort of be able to provide all kinds of reports and analysis, can essentially be able to sort of look at doing some analysis and also looking at some best practices, being able to compare the company to the businesses, to other companies in the same business, being able to benchmark and see where they stand. The other thing is also to look at good financial plans and operational plans that have been put together by the promoter and the finance team, which actually also has cash flow projections and sort of goes into sort of making them also a lot more realistic and sustainable. Because one thing that we see in early stage, especially at the seed and early stage, are these financial projections that sort of have this hockey stick model, right? I sort of start off with 0, 5, 10, 20, and then from 20 I've already gone to 150, and from 150 I'm going to 500, and from 500 I'm going to 1500. That doesn't necessarily work in the real world, and by Series A round you've got enough insight into your business because you've got enough feedback from customers, from the markets, so you should be able to build financial plans including cash flow projections which are much more realistic, as well as operational plans which have KPIs, what kind of resources are needed at what stage, and how operations will actually scale up as the company grows. So all of these are also important for us to actually have. Of course, the other things which are also equally important is to make sure that we are in India, a country full of regulations and full of laws, which also means making sure that the company is in compliance with various things around taxes, regulatory, as well as anything else that may be particularly affecting the company in that particular sector. Corporate governance, essentially making sure that board meetings earlier have been held on time, filings with the regulatory authorities have been done on time, and most of this from a secretarial and from a compliance perspective, including taxes, is clean. That there are also solid agreements in place, whether it's HR and employment agreements, customer contracts, vendor agreements, all of those are also in place. And then the important thing is to be able to actually see whether you would pass the due diligence test. And most investors at early stages will be happy to share a due diligence checklist. And there are enough of those that are also available, which has a list of things that investors are typically going to go ahead and do due diligence on once they've decided to invest into a company. And you want to make sure that from the due diligence checklist perspective, you are ready with all the things that are sort of mentioned in the due diligence checklist. And these are absolutely critical for you to be ready with. So once you've gone through all of that, let's talk about what the fundraising strategy should be. And this is something where, like I said, with Series A rounds, it's fairly common to see investment bankers, advisors, and consultants also involved. But I think it's also important for you as a company and for the promoters and the management team to also sort of have a well thought out strategy on how is it that they want to go out and raise this capital. So like I said, start off with developing the fundraising strategy of who do you want to approach. And this is again dependent on the sector that you are in, the kind of money that you need to raise now, and then the kind of money you want to raise in the future. The reason is because you may probably have smaller funds that may be interested in your sector and may probably be interested in the kind of things that you're doing as a company. But as smaller funds, they may not necessarily be able to come in and do follow-on rounds and give you additional capital. But do they have the kind of track record to be able to bring in additional investors in case they need it? Or do you go and talk to a fairly large, a larger venture fund which can not only write checks now, but can continue to keep writing checks in the future as and when I need more and more capital. You also need to understand and think about who your ideal investors are. Are you just looking at capital? Do you also need significant domain expertise support for your enterprise? Do you need access to people at the regulatory level, or people who sort of understand and know this from a market access perspective? Typical of companies that are in things like fintech, or companies that are in infrastructure, or companies that are doing food manufacturing and things like that, right? Where you want people who sort of understand domain but also understand regulations, who also understand key influencers and how all of them impact your business. So you want to essentially look for investors who have intimate knowledge or have networks that can access this kind of expertise. So the other thing is spend time researching your prospects. So you need to essentially go out there and figure out who are the right set of investors, who are the venture funds, and then sort of research them and essentially find out what kind of companies that they have invested in, and would they be willing to look at a company like yours? And not so it need not be that you just need to pitch to everybody, but you need to also research them before you actually do it. And a lot of venture capital funds appreciate it when promoters and entrepreneurs come in and talk about some of the companies that they have invested in and try and sort of go ahead and relate to them and try and compare themselves or make some kind of a comment about comparison, because that sort of tells us that, you know, as investors, that the company and the promoters have actually looked at us, looked at our investments, looked at the kind of companies that we have invested in, the kind of value proposition that they bring in. The important thing is also to engage with partners and senior advisors at the fund level. I know it's much more easier to sort of reach out to associates and principals, but the partners and the fund advisors are the ones who make the decisions. They are the ones who are making the investment decisions, and you need to engage with them because those engagements are a long-term process. They don't sort of, they're all relationships. You know, this is like dating and going into a long-term relationship. So these are not very transactional in nature. So start those, you know, very early on, because you may not necessarily be able to raise money from a particular venture fund in Series A, but they may be interested in investing in a follow-on round in Series B, depending on where you do. So start building those, because subsequent rounds become much easier. And like I said, I was talking about build those relationships up. So identify the right set of investors, like I mentioned earlier, based on sector, amount of money you need to raise. Determine how to get to them, who has those connects and who can make those introductions. Fundraising is a contact sport. You can't necessarily sit in an office and expect to do this just through LinkedIn or through emails. It's best to get out there, network, and meet a lot of them in person. And an ideal place to meet a lot of these guys are at conferences and events, because a lot of them show up there. And primarily, a lot of investors, we all show up at conferences because we are also looking for interesting companies to invest and engage in. And we typically try to find them at conferences because savvy entrepreneurs and promoters usually come to some of these because most of these conferences could also be learning experiences. And have a narrative, be able to, like I said, be able to tell a compelling story and a simple story. And then be prepared for a sustained campaign. Like I said, this is not a sprint, it is a marathon, and it's going to take a while. So you have to be sort of be able to go through this over a sustained period of time. Then you have to be able to lobby, and lobbying comes through referrals and references, common friends, alumni of investors, alumni of funds, people that they are part of, accountants, lawyers, and common advisors who are part of the network, and being able to actually lobby through them. And test interest. You will get a lot of no's, no doubt about it, but test the interest. It's better to get a firm no rather than a vague answer. And if somebody says no, it's best to sort of say thank you and move on, but sort of saying I can always come back to them later on. Because in the venture capital business, one thing is nobody says no. They're always starting to be very vague, and the reason is because they want to continue to keep engaged, because they don't know where and how companies shape up in a dynamic environment that the markets are in today. So the other thing that I wanted to also talk about are the hygiene factors. What are the prerequisites that typically venture funds are looking for when they're starting to look at Series A rounds? This is of course going beyond customers and revenue, because that's an absolute must. Unless you happen to be, Travis, or you happen to be Bhavin, or you happen to be the Bunsells, and you're going out and doing a new one, and you say you just have an idea and everybody lines up to give you money, right? So that's more an exception than the rule. So in most of this, what is it that most of them are looking for? And that is, like I said, promoters and management and a core team that is actually full-time in the enterprise. And this is very important, because a lot of people will step in and do these things on the part-time, or they have other things going on. And a lot of this has got to do with the fact that there is livelihoods and there is families to support, and people want to make sure that there's enough money around this. But as a promoter and as a core management team member, it's really, really important for some of them, like the head of sales, head of product, a CTO, or the CEO, to actually be full-time in the enterprise and actually be working full-time. So like I said, key personnel are also employees and not consultants. A CFO either in place or a plan to bring a CFO subsequent to a Series A round. In my experience, I've seen several enterprises and several companies where the plan to bring a CFO is made prior to the Series A round, and they usually have an advisor or a consultant or a fairly savvy finance team that actually supports and goes through the entire exercise. But the moment the Series A round is raised, they usually bring on an outside CFO, and that CFO could be either an interim CFO, a part-time CFO, or a full-time CFO. The other thing that's an absolute prerequisite is domain experts, depending on what segment and what sector you're working in. Now, those could be either advisors or could be part of the management team. But you need to definitely have people who have domain knowledge and domain experience and expertise. The other important aspect is IP ownership, especially if you happen to be a technology-oriented company, or you're in biotech, or you're in pharma, or one of those where IP is really, really important, and making sure that that IP actually belongs to the company or to the promoters. And in case of it's the promoters, investors typically want to make sure that all the IP gets assigned to the company, 100%, with no expectations of that being returned back to the promoters. Then, of course, strong customer partnership agreements. Those need to also sort of be there. The other absolute prerequisite is that for the CFO and for the management team to know their numbers, know how the business is being run, where revenues are coming in, what are the levers to push and pull in order for the business plan to work differently. What are the margins? What kind of, how do they compare to companies in their own business, or companies in the same segment, or companies at the same stage? Where do they stand in terms of capital efficiency? What can they do to make this much more capital efficient rather than being capital inefficient? So these are all things that are really important, and these are things that the CFO and the management team need to be able to articulate repeatedly over and over again, because you're doing this to multiple investors, and even within a venture fund, you're doing it to multiple partners, multiple associates, which essentially means being able to do this over and over again with consistency. The other thing we talked about was financials, projections, budgets, and process in place, making sure that there are financial processes in place, there's some controls in place, that you have budgets that you're sort of working with, and you sort of sticking to those budgets and making sure that these companies are sort of run with a well-disciplined manner, especially financial discipline, and that's something that most companies and most investors sort of really appreciate. The ability for you to show that your operations can scale as it grows, and for you to show that there are right sort of resources that can actually do that, the experienced people who can actually build your operations at the back end. Then best-in-class corporate governance and compliance, and the fact that you've paid attention to this, because this also tells people that as you're building a business up, you're also making sure that you're keeping on the right side of the law, and this is really important. Though in India we always have those challenges. So last, I will sort of go through what MyCFO's benefits are, and the fact that I want to do a plug for the kind of experience and expertise that MyCFO brings to the table. We have worked with several venture capital funds and investors, and have had significant experience in working with venture-backed companies, as well as helping raise capital for our clients. We clearly understand, because we have worked with them, what the investor expectations and requirements are, what they look for when they ask for projections, what kind of projections would actually work well for them, and then also looking at use of funds as well, because this is an important aspect of the entire fundraising process as well. Able to implement best-in-class corporate governance standards that meet investor expectations. The ability for us to be able to articulate the company's business model and value proposition. Then for us to be able to actually manage and coordinate the entire due diligence process, because that's something that we can essentially also help with. And this is a very important aspect, because once the term sheets come, a lot of pain and a lot of heartache and a lot of effort goes into the entire due diligence process, because there's documentation, there's operations, and the investors are going to be looking at every aspect of the business, every aspect of operations, customers, and also background checks on on promoters and the management team. And these are things where we have actually been fairly intimately involved in the whole process, as well as in helping negotiate and close out the shareholder agreements, right? Because in the shareholder agreement there is also conditions precedent, conditions subsequent. There are a bunch of conditions that they want the company to fulfill before the funding is complete, and then subsequent to that, a bunch of conditions to be completed within a certain time frame. And of course, ESOP plans have to be implemented, and that's something that we have sort of done and continue to do all the time. And then, of course, like I said, coordinate the entire documentation and close the investment round. Because once you've done that, then it becomes easy for you to actually go ahead and get started with your actual business. So one of the things that sort of gets frequently asked is, should you hire a banker? And in a lot of situations, you do see bankers, investment bankers, who are involved in this. There are some pros and cons. Investment banker, of course, you need to make sure that the investment banker has credibility, track record, experience. They can actually help accelerate a lot of the work that I talked about earlier, targeting the right investor, getting the pitch deck done, financial projections, being able to sort of practice the pitch or be able to sort of tell a very credible, compelling story. All of those things get usually done by an investment banker or the investment banking team. And they can actually help with not only that, but with negotiating terms, valuations, all of that. So they are definitely beneficial and can actually be extremely helpful. But at the same time, they can also be expensive because it's a success fee. But in a lot of situations, especially at Series A rounds, it's not just success fee, but there's an upfront payment that usually also happens with some of the more successful investment bankers. They don't work only on success fee. They also work on certain payments being made upfront or a retainer being given to them in addition to a success fee. So think about those. But then again, in some situations, I've actually seen that the investment banker has made a big difference in being able to raise the capital for a company. But in some situations, we have also seen where investment bankers have actually been detrimental. And the other important aspect to also remember is that even if it's an investment banker, there's no guarantee of success. The odds still remain more or less the same. The last one that I sort of wanted to also talk about was the allocation and utilization of funds, because this is something that Series A rounds or even earlier rounds most investors ask for, and that is what are you going to be using the funds for? So they're essentially very keen on wanting to make sure that they are interested in helping and scaling a business, but they also want to make sure that that money is being used judiciously. So you have to make sure that your use of funds is realistic. There's enough of a runway. You're also sort of using the money for the right set of things. You're not necessarily saying, hey, listen, I got the money, let me go and buy a new BMW or a new Jaguar, or essentially moving to a fancy office in India Bulls or things of that nature, right? So that's one. The other thing and this is a fairly common issue, is the issue of compensation for the management team and for the promoters. Expect to actually sort of get a good salary, but don't expect to get absolutely rich from it. Wealth creation is not going to happen with compensation. Wealth creation happens with essentially being able to build a sustainable enterprise, or in you being able to do secondaries. Most in India, fairly common way for promoters to actually sort of be able to generate and accumulate wealth is through the sale of their equity in a secondary sale to investors, and that's another way of being able to do it. So salaries, don't expect to get paid, like I said, fancy salaries. And then tie use of funds to real traction milestones. Look at what kind of milestones you can actually sort of achieve. And then, if there are tranches that are being talked about for your Series A round, because most Series A rounds or Series B rounds usually happen in tranches. And those tranches could be 1, 2, or multiple. And in those situations, just make sure you sort of tie up the release of those tranches to milestones being sort of achieved. The last is the fact it's investor relations, and this is one which is actually a sore point for a lot of investors on the other side. I've gotten married but my expectations are still not being met. I mean, I had all these expectations, and at the same time, those expectations are not necessarily being met, and the investor usually has these. So the most important thing is for you as a company or as a management team to be able to communicate and communicate all the time, right? Monthly updates that are very detailed. Talk about successes and failures, where you need help. Get on the phone or ask them about meeting them in person in case you need help. Go and do these regular financial updates, and these are things that most investors actually look for. And there's also is a hygiene factor. So if you are successful with your Series A rounds through all of this, your subsequent rounds become much more easier. And if there's no surprises, you actually are able to build your business up much more faster and with more support than rather giving surprises. And like I said, ask for help, recruitment, product launch, advice, whatever else is out there, and meet in person regularly. You can definitely go ahead and meet them, not just board meetings, but you can actually have regular, conversations and meetings with them, and document each interaction with them, and with follow-on action points. So I'll end it at this, and I will actually open it up for questions. Happy to take questions as they come up. So Vaibhav had a question on the average time for closing a deal by investment banker. So even if it's an investment banker who's involved, typically the investment bankers tell you anywhere from 6 to 9 months, and that's usually the standard, and that's also the standard even if you don't have an investment banker. Probably if you don't have an investment banker, that may sort of go up to almost a year, but typically investment bankers get it done anywhere from 6 to 9 months. If somebody says 3 to 6 months, then they're being overly aggressive. So any other questions, we'll be happy to take. So Suresh, you want to know, investors who would be interested in our projects. So this essentially comes through meetings or asking questions through your networks, and also sort of going out and looking at information about these investors, right? Most investors, usually if you go to the websites or through the press, will have a list of companies that they've invested in, and that tells you as to the kind of companies that they're investing in and the stage of company at which they've invested. So most of this comes from them. You can pretty much ask some of them as well, and ask them as to whether, listen, I have a company that's a seed stage or early stage, or a company which is essentially growing but needs now expansion capital, and would you be interested in doing it? So you will actually have most of these investors will actually sort of go ahead and do it. Yes, MyCFO can help. Investment bankers for new startups. There are investment bankers who sort of specialize with early stage and startups, but then again, you have to realize that the amount of money that you're raising is fairly small. So ideally, you should try and do this on your own. But if you're not able to, or you think that an outside investment banker can help, definitely use them, because they can definitely help and so in some cases accelerate the process. Thank you, everybody. I think those were Suresh. So I have got some more questions. So let me answer them one by one as they've come across. MyCFO helping with angel funding. We can sort of we look at them, and we don't necessarily get involved at the fundraising for all our clients. We do it very selectively, but we would be happy to take a look and see if we can actually help. If you're not, then we can sort of refer them to people who can actually do that as well. Atul asked about venture capitalists being interested in investing and eventually taking over a profitable, scalable venture with revenues locked for 3 to 5 years. Typically, venture capitalists are not interested in taking over companies because that's not their main business. Their main business is just investments. So they're not necessarily looking at taking over companies, and that's not something that they would be interested in doing. If you're looking at an exit, they would typically try and find somebody who can actually buy the company out rather than them buying the company themselves. And then, of course, CS Sunil had this question on the possibility of getting funds initially on concept rather than numbers. Concept only on a concept stage, it's usually friends and family. Very in these days and age, very hard to get angels or venture funds to actually commit capital at that point. If you are able to do that, then you probably have a very compelling reason, and the investor sees that and decides to do it. But those are extremely rare. Any specific sectors favored by investors? Right now, it's not like there's any flavor of the month types. Of course, e-commerce is definitely out. Nobody's really funding e-commerce unless you happen to be a Flipkart or you're somebody who's really focused and really growing in that. IT product, SaaS companies still sort of have interest. There's definitely interest in looking at impact. So impact still gets a lot of interest, and people are still looking at social enterprises. People are still looking at a lot of cross-border medical devices, healthcare, ed tech, and of course, fintech. Of course, now a lot of people are also looking at things like artificial intelligence, machine learning, deep learning, all of those. But at the same time, there are funds, including venture funds and private equity funds, that also look at traditional manufacturing and are still interested in investing in manufacturing as well. So I think that's the last one. And thank you all for joining the webinar. And if there is anything that we can help with, feel free to sort of write to us. My email is right here on this, and then you can also go on to our website and get more information on how we can help and connect with us through the website as well. Thank you.